Joining us right now to talk global risks and the markets is Scott Wren. He's senior global equity strategist at Wells Fargo Investment Institute. And Matt Slaughter, who is the dean and international business professor at the Tuck School of Business at Dartmouth. Scott, let me ask you today, since we're looking at the futures up so sharply, are you feeling calmer about things? Are you feeling better? Or do you think that this volatility is going to be here to stay?
Well, Becky, from our perspective, it's going to be here to stay for at least the intermediate term. I think, clearly we're very susceptible to any trade headlines, whether it's to the upside or the downside. For us, our year-end target for the S&P 500 is a touch over 3,000. So we're not that far away from fair value. And what we've really been trying to do here is we lightened up a little bit on stocks back in March and April. We're looking for an opportunity here at the on the downside, but we touched overnight that 200-day moving average, but somewhere between 2740, that's the June low, 2790, which is the 200-day moving average approximately. That's probably a pretty good buy zone. So for right now, I think if stocks run up, we'll probably lighten up a little bit. If they fall down, we'll put a little cash to work that we raised a couple of months ago.
Hey, Matt, we can think that we control our own destinies here, but looking around the globe, you're an international business focus, and really what's happening around the globe is determining what's happening here, not only with what's been happening with economies there, but also with central banks, kind of everybody on this race to try and get the easiest, the fastest. China doing that today. We're seeing a little bit more about that. What kind of pressure does that put on our Federal Reserve?
It puts pressure to think about the impact of those policy moves in terms of prices in America and output. I think it's important to go back to first principles on that important question. The Fed's job is to try to maintain full employment and price stability in America. Now, what exactly that entails isn't exactly written down in the legislation. So our colleagues at the Federal Reserve today, they look at a 3.7% unemployment rate. They look at a lot of measures of the job market, which are quite strong by historical standards. The big puzzle, I think, has been that price inflation hasn't been higher than a lot of people would have expected. So the Fed today is looking at what the ECB does, what the Bank of China might do tonight, what Bank of England is going to do as they think about Brexit. All those forces, as the U.S. economy has become more global through trade and investment and immigration flows, all those policy choices and economic developments in the rest of the world, they have to factor into what the Fed does.
So would you expect to see interest rates heading down? They've firmed up a little bit today, but would you expect longer term that we're going to continue to see pressure on our interest rates as a result of all of that?
Low inflation in America tends to make the Fed more likely to ease. So I think what we've seen in recent times with the speeches coming out from Chairman Jay Powell and other key Fed officials is they're realizing the data are pretty mixed. They're realizing that the policy statements coming from leaders in the rest of the world are changing by the day. They're trying to process all that, and that feeds into what they think about for changes in interest rates.
Scott, specifically in terms of the sectors that you're watching, are there some that you think are discounts or bargains at these levels, if you look at financials or others, or do you think that you would be steering clear and maybe try and stick to some of the consumer names that have done better to this point?
Well, for us, consumer discretionary technology, we continue to like those. What we don't want our clients doing, Becky, is getting overly defensive. And, when you've seen some moves, whether it was back in December or what you've seen here in the last couple of weeks, retail investors get very nervous and they sit on their hands, really. They tend to not sell and not buy. But what we're trying to do is when the market trades lower, these more cyclical sectors like tech and consumer discretionary, they're going to lead the way down. There's no doubt about it. And that looks like an opportunity to us. We don't think this expansion's over. The risks have certainly increased over the last couple of weeks, but we think we're going to be okay. And 12 months from now, we're looking for the S&P 500 to be a little bit higher than where it is right now.
Matt, what's your biggest concern? What do you think is the most likely boogeyman if you're looking for any of these things? What concerns you the most about what could bring back to our economy and our markets?
Yeah, I think it's uncertainty over the trade war. So it continues to worsen. And there's, as Scott just rightly pointed out, sort of day to day, there's different statements about what might happen with Huawei, which tariff rates might go up when. So that all feeds into uncertainty for all the leaders and businesses, small and large, in the United States. You look at confidence and outlook for CEOs of some of the largest companies in America and small businesses as well. They're less certain about what's going to happen in the future. That tends to feed into more reluctance to hire, more reluctance to undertake capital investment in new ideas. And if we look historically, think about what causes recessions, what tends to drive recessions is a downturn in capital investment and a bit of a slowdown in consumer spending. But it's really what businesses do oftentimes that's most volatile in terms of driving downturns and recessions. So when we think about the next 12, 18 months, it's just not clear. Hopefully that negotiators in Beijing and Washington are getting back to first principles to see where there's areas of agreement on what changes might happen in China that would benefit the Chinese economy as well as the United States. That hopefully is happening to try to resolve what's going on with the trade war. But that's, I think, the biggest concern.